Hello, Maverick traders. Welcome out to your non-directional options option lab for horizontal spreads. I love these option labs. They're a lot of fun where we get to dig in, look for a trade, kind of take a trade through the process of crossing T's, dotting I's, making sure that we've analyzed the different components and what might be in play for a horizontal spread. As always, we remind you that everything we go through is intended to be educational, instructive. This will be a paper trade example. It's not a suggestion to go out and trade the things that we discuss here today. So in order to find a trade, there's different processes that might be in place. One of the approaches that we like to take is kind of a top-down approach. So you might have an overall market viewpoint, the Dow, the S&P, the NASDAQ, kind of say, okay, well, what do I think the market's going to do? What do I think various sectors are going to do? Bullish, bearish, neutral. And then find something that fits that criteria. In this particular strategy, the horizontal spread, it is a volatility trade, is a big component of that. And so we might even do, I'll go to the NASDAQ earnings calendar, which isn't a bad approach. And this strategy is one, you might say, well, do I want to trade it through earnings? Probably not, because I'll talk about why, but we might trade it into earnings. And what do I mean by that? Well, we might trade something and we'll go out a few weeks and say, well, what reports earnings, let's say in, September, and just see if there's a big name like DocuSign or something like that, Sienna. Now, what I'm getting at is we're doing a scan backwards, but let's say that we found some candidates. We might like something that has earnings a month or so away. We might like that aspect of it, and we might plan to trade it up to that earnings, but then bail out of it before earnings occur. Why is that the case? Well, it has to do with implied volatility. With these strategies, and let's just use DocuSign, what the heck? We don't, this is just for educational purposes. If you take a look at something like DocuSign, here's the implied volatility, and you can just see kind of think of this as like the cost of insurance, right? And what tends to happen, so we know that it's going to report earnings where? Well, about early September. So let's kind of mark this date out here. I need to change the color. So they're going to report in about a month's time, somewhere out right in here is the date. Okay, September, you can see that, early September. So where did they report earnings last time? Well, companies report earnings basically once every 3 months, and usually there's some telltale signs. You can see, and I didn't look at DocuSign but ahead of time, but you can see if we go back 3 months, it would be August, July, June. They probably reported in early June. Oh, that's kind of a telltale sign that they reported earnings. See the volatility in the stock, but what do you notice about implied volatility? What happened to implied volatility post earnings? It's gone down. See what's starting to occur to implied volatility? It's creeping back up. Where did it report earnings before that? Well, let's go back 3 prior months, right? Somewhere in early March would be my guess. What do you notice about early March? What do you notice about back here? What did the implied volatility do going into earnings? What did the implied volatility do after earnings? This is what I'm trying to emphasize is people get really nervous, and that's seen in the option pricing going into earnings. So does the cost of options tend to go up or down? Well, option prices tend to go up. Implied volatility tends to rise, or options inflate as people get nervous. Uh-oh, earnings are approaching. Uh-oh, what might they report? There's a lot of unknowns. Once the earnings come out, the unknown has become known. At this point, the news is out there. Most of the time, maybe it's not, the bark is bigger than the bite, right? People kind of breathe a sigh of relief. Okay, well, now I know what it is. Does the fear go down? Do option prices deflate? Yes. That's essentially what happens post earnings most of the time. Going into earnings, implied volatility rises. After earnings are reported, implied volatility drops. Going into earnings, we expect it to rise. Kind of, I don't know exactly how it'll work, but rise into earnings. When they report earnings, where do we think implied volatility will probably trend thereafter? Down. The unknown becomes known. The implied volatility drops. Here's where it's important. Which options are most impacted by changes in implied volatility? The longer term options. So I don't want to experience this. I want to experience this. In a horizontal spread, in a calendar spread or a diagonal, I want to be in it while the implied is rising and then probably bail out. Probably plan my trade to maybe get out pre-earnings. Exit the trade, move on. Hopefully I've got some profit to show for it based on price move and based on the implied volatility increases. So we want to own it as implied volatility is rising. If implied volatility drops dramatically, the horizontal spread is probably not going to be a beneficiary of that because your long-term option is going to take a big hit and it has a bigger Vega number. It has a bigger implied volatility Vega number, meaning if both options lose value based on implied volatility dropping, my longer term option gets hit harder. Not what I want. So is this a good time to maybe trade one in DocuSign? Yeah, because they don't report earnings for about a month. And over the next month, implied volatility will probably rise. We just need to plan the trade to be out before earnings, hit. So if we go back to that earnings calendar and we look at this calendar, DocuSign is set to report, what date is that? Thursday, September 2nd. So when might be our expiration? Maybe the end of August. This will have weekly options. So we'll probably, plan that first expiration for what? August 27th or something along those lines, okay? What do we think about DocuSign? What do we think about the chart? We're moving a little bit backwards, but because we want to analyze, is this a good setup and all those things, and then say, okay, do we have some time before earnings, which would be a good time to be in it? But I wanted to teach that concept and find something that would fit. Well, what do you think here? Is DocuSign a reasonable candidate? And what would be our target? Well, if we just look at this technically, the trend is up. There's a breakout and a retest. See how it kind of moved above the resistance zone, kind of bounced off of that. Is it going to go higher? Yeah, maybe. I don't see any reason to be super bearish by any means. The trend seems to be up. I don't know if it's, the perfect candidate. Usually if I saw something that was a little more exhaustive, I'd feel even better about it just kind of consolidating at a certain zone. Stock's trading at 291.70. Maybe we put something on that's just kind of expecting it to be in this 300. Maybe this is kind of where it'll be, in this 300-ish zone. So if we think that it's going to kind of stay pegged to 300, given the volatility of the stock, that might sound like a lot of movement, but $8 for DocuSign is nothing. I mean, to put it into perspective, this one-day move right there, on the gap was probably 30 or 40 points. Just in the last week, it's gone down 20 or 30 points. So that's a neutral trade. $8 sounds like a lot, but we're dealing with a $292 stock, and its ATR is probably, sky high. We could add the ATR on there, or I probably already have the ATR on this other chart. Let's pull it up over here. DocuSign. Well, I don't have the ATR, but whatever. We can add it quick. So you can see this thing moves on average per day $9.25. Like I was saying, a 30 a 300 strike, you know, calendar horizontal spread is neutral. In fact, it moves $10 per day. So that's very, very neutral expectation. Now let's think about the structuring of this trade. So we come back to, let's just use think or swim. We'll go to here. We know earnings come out early September, so we could go August 20th, which is the monthly, or we could go August 27th. August 27th would get us closer to earnings, but these options would be weekly options. They would be less liquid. They wouldn't be as heavily traded. I certainly prefer trading monthlies. You'll notice as a sign of liquidity, see how the stock's at 292. Look at this. If I trade the 2 or the 300 strike in the monthlies, 20-cent spread between bid ask. Okay, that's good, no problem there. If I go to the weeklies, it's going to be worse. I'm pretty confident to say. Maybe it won't, but normally is. Here's the 300. Now we're dealing with a 60-cent spread. Now we're dealing with a 70-cent spread, rather. No, 60 cent. I was right the first time. So a 60-cent spread versus a 20-cent spread. I'm going to use the August 20th. That's going to be my short. And then we'll reassess at that point in time. That's pre-earnings. Over the next 17 days, should implied volatility keep ticking up? Sure. And we're kind of playing this stock to consolidate over the next 3 weeks. It's going to move. It's going to chop. But we think it'll kind of stay in this 300-ish range. Now, what option do we buy? Well, we'll probably come out here to a monthly. Maybe the September. You could go as far out as November. But something like buy September, sell August, that could be reasonable. If they had an October, I'd probably go with that one. If November's out there a ways, that's going to be a little more expensive. Let's just build the September. So let's see what this looks like. Again, more liquidity because we're trading the monthly options. I'm going to right click. We'll just buy a calendar. Same strategy. It's just a different name. That's the horizontal. I'm going to buy, what did we say? We'll buy September 300. We'll sell the August monthly 300 call. And that comes out to an 870 debit. I'm going to right click and let's analyze this thing and look at the risk graph. So here's our risk graph for this DocuSign horizontal spread. See where we max out our profit. Our target is 300. Whatever strike prices you're trading, that is your target. Make no mistake. So we're trading the 300 level. Now, the further it gets away from that, the bigger the problem becomes, right? So if the stock tanks, we got an issue. If the stock blasts off to the upside, we've got an issue. We don't have a lot of time for this stock to get away from us because there's only 17 days total to that August expiration when we can reassess and, kind of go from there. But over the next 17 days through August expiration, it says, look, here's your one standard deviation. Here's your probability range. There is a 68% chance that we are going to be somewhere between here on the upside and here on the downside. Now, our profit zone, you can see, is this window. Now, is it better for us if this is a little too bullish or a little too bearish? Well, you can see that if it's a little too bullish, we're in a better spot than too bearish, given its probability. If we're wrong and the stock tanks, that's where you've got a problem. That's where the bigger losses mount. If it stays in this probability range, but it overshoots on the upside, we could be down a little in the trade. This is still negative, but it's not down much. So we're positioning this trade where our max profit zone is a little above current prices, and that gives us more room to the upside. We certainly are more bullish than neutral. We're certainly more bullish than bearish. We need the stock to tick up a little bit to get better return, better profit potential. As you look at this trade, you can kind of cursor over different things. This will show you that you could make up to about $600-ish in the trade from now to August. You could lose if it's outside of here. So we talked about trade management. Would it be reasonable to maybe stay patient if it's a bullish move, knowing that that's probably not going to be the side that hurts you, but to have some sort of trigger to get out of this thing if it's going the wrong way? Could you have set an alert that says, look, if this stock gets down here to 277, 276, 275, I might just need to bail. I'll take a couple of buck loss. I'll lose $300 or $200 or something and just bail out. I would be more inclined to set an alert on the downside and be much more inclined to be patient on the upside, given the risk graph, given the probabilities and such. I'm not super worried about this thing overshooting higher. That can happen, but that's not the concern. The bit deeper concern is the bearish move. That's given the probability, here's where the stock is at today, we're unlikely to be hurt, in any significant fashion up. But if it goes where it could go, probability-wise on the downside, that could be painful. Because by expiration, if it's had the bearish move, we could be down quite a number there. So I would be more inclined to stem this trade, close it off. If it's not getting the reactions that I want, not staying neutral, not acting more bullish, if we get down there in the 270s, you might just cut it loose and have a game plan for that. How do we manage this trade at expiration? Well, this is probably a trade where you're looking to exit, given that earnings are coming out, given that implied volatility will likely drop post-earnings. So I'm probably trading this for better or worse into August, trying to make, this is only one contract, but my realistic reward is to make a few $100, a couple $100, $300, $400, $500, $600. Anything like that is very possible. And losing a couple $100, very real possibility per contract. I'm not going to be at max risk in all likelihood, and I'm probably not going to perfectly land at max reward either. So this is a trade where we're going to get out for lesser than our $870 max risk. We'll probably be down a couple $100 given the probability if it doesn't work out. And if it does, we'll probably be up a couple, $100 on the upside. So kind of a fun little trade there that you can look at. And one of the things that I would really emphasize again is that concept of implied volatility, because I think it's super important with this strategy that you're trying to trade these when implied volatility is rising. That's going to be a benefit to your positioning. That's the sweet spot. So if you had on a good horizontal, calendar spread back here or in this period of time, and so on, when volatility is rising, that's what we're looking for. You can see this implied volatility rising during that period of time. If you were trading this stock, and this is a good example, stock went sideways, implied volatility kept going up during that period of time, that would be a perfect window for the horizontal spread. And that's what we would be looking for. In terms of other approaches to this, so one of the things that we talked about, well, you could, of course, come in and do scans and different things. DocuSign happens to be in the tech sector, so this would work really well if you were a little bit more neutral-ish on tech. If you came to the conclusion that, look, it's not a bearish sector, quite clearly, this chart is bullish, but if you think that it's going to be doing more of what it's been doing, now if you think it's about to break out to the upside, it's probably, again, going back to that DocuSign chart, remember, we weren't super worried about the upside. If it starts to go higher, we're going to start to see some profit. So we feel pretty good if this sector is going to be +1, and DocuSign's going to move +1, going to be mildly bullish. Okay, great. I got no problem with that. If you look at this and you say this tech sector is about to explode and it's going +2, +3 upside, and DocuSign going to do the same thing, not the right structure. We'd want something that was more bullish. But I think given the sector, the market, the stock, we kind of came into it. We didn't come into it from a top-down approach of let's check on the market, let's check on the sector. We kind of went the backwards route of finding a stock. That's called a bottoms-up approach instead of a top-down. We found the stock and then we worked back. But that's perfectly fine. If you have earnings coming out during the time period of that trade, it certainly puts a damper on this strategy. And we're in the current market for earnings. Now, some companies have just reported earnings, but again, that's probably not the right time for this strategy, because if you take something like, I don't know, Amazon or whatever, let's just go look at the chart. So if we go Amazon on the chart and look at the implied volatility, even with the stock gapping down hard on earnings, look at what implied volatility is doing. It's still dropping. And so, you might think, well, it's going to consolidate and so on. That would be good for the strategy, and you could make money if it was really precise. But if implied volatility keeps going down, it's really not the ideal structure. So where would have been a better spot? Well, of course, during this phase where that implied volatility was rising, and notice that it happened the weeks leading up to earnings. It's a pretty predictable cycle that these companies go through. The ones that will not repeat this cycle of implied volatility going up leading up to earnings, and then the volatility crush they talk about, that's so common post earnings. The unknown becomes known, the volatility gets crushed. Well, if you have really, really low implied volatility and you're just not what I'd call a trader stock, then this dynamic may not play out. Like if you're looking in the utility sector, let me pick on them a little bit. The utility sector is not a real trader's sector. There's not a lot of volume, liquidity, momentum, volatility. They're just they're utilities, right? They, are regulated. They can make X amount of money. They're just boring. They're almost like bonds or something. So they don't have quite as predictable cycle, probably just because they're just not volatility creatures. If you're trading DocuSign or Amazon or Snowflake, to name some tech names, or if you're trading energy stocks or material stocks, things that have some momentum, some growth, some volatility to them, this is a pretty predictable cycle. So with that, let's come back and tie a ribbon on things. So in review, find an acceptable symbol to build a trade. You can go top down. We kind of did a bottoms up approach, but find your niche, run it through your system. Determine your strikes, which ultimately are your target, and your expiration. For this strategy, we like to get out pre-earnings, build the trade, analyze the risk graph, practice on a demo account, perfect your order entry, trade liquid options. I showed you that trading the monthlies better than the weeklies. They're more liquid, better price executions. That's important, getting in and getting out of the trade. Hope you've enjoyed this trading lab. Have a great rest of your day. We'll see you next time. Goodbye, everyone.